Ryan, welcome to Real Vision.
Thanks, Ash. Great to be here.
It's great to have you. You know, we were talking a little bit before we got started about our journeys into the crypto space. Tell us a little bit about your background.
Well, I went to computer science school in Canada, and from there, I've done a tour at some startups about 10 years ago at Amazon.com. And from there, I went to a wonderful fintech startup in Manhattan where I cut my teeth in finance. And while I was there, my love for crypto, which had been in the back burner for some years, had really flourished. And I had to get involved. So I've been full-time in the space now for a few years.
So tell us a little bit more about the details of how you got involved in the cryptocurrency space.
Well, when I was in computer science school, we were in a computer lab late one night and started playing around with the Bitcoin software. And because we were in school and in the thick of the theory, it was immediately obvious to us that it was novel. Yet we didn't buy any. We didn't save our wallets. It wasn't that time, Otherwise, I'd probably have my Jeff Bezos mega yacht behind me instead of where we are today. But having been bitten with the crypto bug fairly early on, I had the advantage of always knowing it wasn't, a scam and that there was novelty. And so over the years, as Bitcoin grew, I still wasn't invested in a major way. And we saw that more and more stakeholders were getting involved, that there was evidence that these open networks might be the future. And then along came this fellow named Vitalik Buterin. And Vitalik had this idea that, great, the novelty of Bitcoin is that we can now make a public computer network that is a consistent, reliable system, even if up to half the participants are malicious or incompetent. And Vitalik says, let's glue an app platform to that. Let's make an app platform where you can run financial applications, different kinds of applications, and let's put it on the blockchain. And at the time, I was very lucky to watch his launch webcast the day of. And I had an opportunity, which I did not take, to participate in the Ethereum crowd sale. So I let the crowd sail by. And for a few years, I watched with great interest as Ethereum began to take shape and early apps were written and mainnet was launched. And it was just so exciting. And eventually, when I was working at a fintech in Manhattan on consumer finance, totally traditional, nothing to do with crypto, there was a catalyst, and I realized I'm an investor. I can get into this. This is going to change the world. And I took action, and I heavily invested personally over the following years. And now I've been an active community member for several years, and it's just been an absolute joy, Ash, to watch this space come together. And those of us who are closest to it believe that it's going to change the world and provide dignity and open access to financial services for billions of people. So it's just been a real pleasure.
Ryan, that's so elegantly said. Sometimes it's hard to get a view of the big picture, but I think that brings it into focus very clearly. Tell us a little bit now about what you're doing as an investor and also as a community member in the Ethereum space.
As an investor and not a trader, I focus exclusively on concentrated bets.
Hi, I'm Raoul Powell. Sorry to interrupt your video, I know it's a pain in the arse, but look, I want to tell you something important. I can tell that you really want to learn about what's going on in financial markets and understand the global economy in these complicated times. That's what we do at Real Vision. So this YouTube channel is a small fraction of what we actually do. You should really come over to realvision.com and see the 20 or so videos a week that we produce of this kind of quality of content, the deep analysis and understanding of the world around us. So if you click on the link below or go to realvision.com, it costs you $1. I don't think you can afford to be without it.
As an investor and not a trader, I focus exclusively on concentrated bets over the long term. And in particular, bets where I believe the thesis for both growth as well as defensibility are unambiguous, where I get a certain sense that the unknown unknowns may be of reduced scope or at least manageable. Or there's some sense that there's this evidence that even as this thing gets big, we have confidence that nothing's going to swoop in and take that opportunity, that, that premium from our investment. And as a result, I focus primarily on investing in independent blockchains. And my most concentrated investment, call it over 95% of my crypto portfolio is in Ethereum. And as an independent investor with no LPs or board members or anyone that I owe a consistent narrative to, I can change my mind whenever I want. And so as a community member, I spend my time essentially on public education, as well as avidly reading about all the aspects of the space that may affect the ETH investment thesis. And every morning I wake up and I grab my coffee and I say, what's going to derail my crypto portfolio today? And I bring that open mind, and I read about the app layer projects. I read about competing blockchains. I read about the latest Ethereum research. And what's remarkable is that there's basically almost no yellow flags and a lack of red flags. It just keeps getting better and better and more defensible. So it's been really cool to watch it grow. And as a community member, I've really pivoted towards public education in the form of long form Twitter threads, trying to come up with original ideas, move the space forward. Most recently with our report, ETHEREUMCashflow.com, which is just a 4-pager that describes how we believe Ethereum is transitioning from being a confidence-based investment opportunity into a cash flow-based investment opportunity. So, somebody call Buffett, because we think Ethereum is going to be just printing money for Ether holders over the next few years.
Yeah, that's really interesting. A 90% concentration obviously is a very substantial concentration in one particular asset. So tell us a little bit more about that. We'll get into the report in a few moments. But when you think about this is something that's a longstanding thesis of yours. You mentioned 2 characteristics, specifically growth and defensibility. What is it about ETH that gives you the sense that the growth and defensibility is there to such a great degree that you'll concentrate at 90% levels in it?
When it comes to Ethereum's growth, what really clicked for me is that the nature of the Ethereum blockchain and the apps you can build on it is truly novel and valuable. And so we had a sense that over the years, as long as the supporting elements were in place, we feel confident that growth is going to occur. So what is the novelty and what are the supporting elements? The novelty is that Ethereum as a world computer effectively cannot lie.
Can you explain that to people who may not be have computer science backgrounds? What does that mean?
For sure. When Satoshi Nakamoto invented Bitcoin, he or they invented a system whereby for the very first time in history, a public network of computers could be trusted even if up to half the participants were malicious or incompetent. Now, Ethereum comes along, founded by Vitalik Buterin, and Ethereum had this insight that, wow, we can do what Bitcoin did from a reliability standpoint, and we can turn it into a computer. We can turn it into an open access public utility that anyone who pays the fee is able to create their own application or use an existing application, either as an end user or a middleware provider, completely open access world computer. Now, what has followed from that is this idea of credible neutrality, which is this transformative, world-changing idea that we think folks are going to be talking a lot about over the next few years. And credible neutrality is the idea that if you're a small country in Europe and you have an agreement with a much larger country, say it's America, and 2 years into that agreement, America decides that they want to change the rules of that agreement. You, as a small country, have limited recourse. It's an asymmetric relationship with America. Ethereum offers the promise of changing that because the terms of the agreement can be encoded on the Ethereum blockchain, including, for example, financial recourse, where if certain conditions aren't met, you gain the ability to claim a payment from the counterparty and any other manner of clever recourses and mitigations. And so credible neutrality is going to usher in a new era of a level playing field of global trade prosperity among nations and mega corporations. It'll be almost like there's an independent nation living on the moon, and we can say, excuse me, independent nation, can you please be the arbiter in our disagreement? Can you please enforce the rules of our game? And Ethereum has the ability to do this, and it has the ability to do it at scale. And it turns out that the kinds of force-based recourses, things like, I have a bigger military, so I'm going to get my way. It turns out that the Ethereum blockchain doesn't really have a lot of exposure to that. And so this idea of credible neutrality is going to allow the world's mega corporations and governments to come onto Ethereum and do their business on Ethereum in a way that offers an unparalleled level of transparency, level playing field, as well as novel capabilities that are just straight up better than the current financial system. So an example of those two capabilities would be instant settlement, where when we're on Ethereum and we hop over to Uniswap.org, and Uniswap is the most famous crypto app today. And it lets you take one token and swap it for the other token. And when I execute that swap and I pay a transaction fee to Ethereum that later this year will begin to accrue to the holders of the Ethereum token Ether, that's an instant settlement transaction. There's no T+2 there. That's it. It's done right away. And as a consequence of instant settlement and programmatic finance, it creates a robustness and a almost like a lubrication for the whole system to be kind of faster and tighter. A great example of that is that in a recent crypto drawdown where the prices of popular tokens crashed 50% in a day, the whole Ethereum blockchain was humming with liquidations and adjustments, and none of the major apps broke. There was no need for a bailout. There was no need to call the Fed and ask them to print money to save us from this drawdown. The whole system simply worked. And a lot of us find that deeply appealing, and we think it's the future of finance.
That's a very good big picture description of strategically what's happening, why it's important. I think for many people who remember the 2007, 2008 financial crisis, the point that you made about having a financial system that works without intervention is something that is really resonant with those of us who were watching and covering that crisis, and certainly for people who were participating in it. Give us some more examples, a little bit more detail about some of the applications for this, kind of at the tactical level, that people can understand in terms of what the functionality is.
Right, Ash. In crypto, in Ethereum, there is a mechanism called a flash loan. What's a flash loan? A flash loan is the idea that because of the magic of the Ethereum blockchain, for the first time in history, we're actually able to have a type of loan that has literally zero risk of credit default. And where it comes from is this idea of Ethereum transactions. Now, if you have a technical background or you've talked to your database person once or twice, you may have heard the phrase database transaction. And all that means is that you're doing a series of operations on a computer, and they either all take effect as a unit, as an atomic set of operations, or none of them do. That's the idea of a transaction. And interacting with the Ethereum blockchain and Ethereum applications works the same way. You start a transaction, you do your token swap or your arbitrage or your borrowing or whatever it is you'd like to do. And then you end your transaction and the whole thing takes effect on the blockchain, on the Ethereum blockchain as a unit. A flash loan is the lovely idea that at the beginning of our transaction, we can borrow like $50 million or $500 million, and we can use that $500 million for the series of operations in our transaction. And most popularly, this is arbitrage, but it doesn't have to be. And then at the end of our transaction, we're going to go ahead and pay back the $500 million. And we've actually just borrowed $500 million inside a single Ethereum transaction. And the way that the flash loan facility is coded in the Ethereum blockchain, it will cause your Ethereum transaction to fail and revert and roll back unless you've paid back the loan. And that's how we're able to borrow $500 million instantaneously with literally zero credit risk. So pretty novel stuff.
Yeah, this is a fascinating point. And for people who have financial backgrounds rather than technical backgrounds, this notion of the collateral being secured on chain and being programmatically executed in the instance of a technical default is something that I think for people with finance backgrounds, people who remember 2007, 2008, the 2011 European banking crisis, this is something that has a great deal of resonance.
Oh, certainly. And it speaks to the anti-fragility of the Ethereum execution model. And another thing it speaks to is how Ethereum, by reducing transaction costs and creating novel capabilities, is enabling completely new forms of labor models. And I'll give an example, Ash, around the arbitrage space. Prior to the invention of flash loans, in order for an individual contributor to be an effective arbitrageur. So they want to cause prices. There's two different markets, and they want the prices to line up in those markets. And they're helping out in terms of price discovery, and they're also making a little buck themselves as they correct these prices. And if you wanted to do that at scale before the invention of flash loans, you needed three things: a plan, capital, and a seat at the table. With flash loans, which are available to anyone, and the open access model of Ethereum, that it's a level playing field that anyone can use, we've eliminated items 2 and 3 on that list. And so a smart person with the math background who's just a lone wolf in their apartment, they can make a state-of-the-art arbitrage system, and they don't even need their own capital these days because their arbitrage program is able to borrow that 500 million, and it can be that amount. You could borrow $1 billion in a flash loan, and then you're able to be an arbitrageur on your own terms without your own capital. And so
But let me just ask. So when you're talking about the absence of capital, give us a little bit of an explanation for why that is possible. Because I think a lot of people are going to be baffled when they, particularly if they come from the traditional finance side, when they hear the idea that you can somehow get a $500 million loan. That has to be collateralized by something. There has to be something backing it. Tell us a little bit about how that works.
As I understand it, I don't have a traditional finance background, but as I understand it, there's this idea of arbitrage and dirty arbitrage. And dirty arbitrage may have some potential volatility risk in terms of you've entered into an arbitrage position that if the prices change under you while the position is open, it will cease to be an arbitrage position, cease to be an arbitrage play, and become something more like a regular investment.
Right. This is the difference between riskless arbitrage and risk arbitrage.
That's right. Within crypto, there's two classes of riskless arbitrage. And the first is going to be very familiar to those with a financial background. And the second is brand new, enabled by flash loans. And it takes the concept of risklessness to new heights. In traditional riskless arbitrage in crypto, you might buy on Coinbase with your robot software, and then you're going to sell on another exchange such as Binance or FTX. And you've done this instantaneously. And in the traditional finance world, we would consider that as riskless arbitrage.
Yeah, and just set this up for people, this is about price discrepancy. You see something that's selling at one price on exchange X at another price on exchange Y. If X is lower than Y, you can buy on X and sell instantaneously on Y and capture that profit. And ultimately, from a market function, that helps to level prices, make them more efficient, and gives greater liquidity.
That's right. And as DeFi on Ethereum has matured, we've seen that multiple kinds of so-called on-chain trading facilities or decentralized exchanges have grown up on the Ethereum blockchain. So just as in the traditional crypto finance world, we have Coinbase and Binance, which are two different corporations, two different exchanges that run crypto exchanges. And those two exchanges may have price divergence that enables arbitrage opportunities. We're now seeing the same thing, well, really now for many years, but it's really flourishing and maturing now and growing. We're seeing that on chain in the sense that there are two different, or a dozen different on chain decentralized exchanges. And as their prices diverge, arbitrageurs are able to step in and correct those prices by running Ethereum transactions. And where the flash loan comes in, Ash, is if I'm doing my arbitrage with Coinbase and Binance, I need to have my 500 million balance on Coinbase and my 500 million balance on Binance. And then I later have to reconcile those cash flows if too much of the money goes in one direction or to one exchange. On the Ethereum blockchain, because it's a single cohesive computer that the whole world shares, first of all, my money's not in two places. It's just in one place. It's just on Ethereum. So if I have my $500 million, it's on my Ethereum account. And as I run new Ethereum transactions, I'm able to choose what, hey, I want to take my 500 million and I want to spend it on decentralized exchange A or B or C, or all of them at once in the same Ethereum transaction. But with the invention of flash loans, I don't even need my own 500 million because I can start in it. My software can start an Ethereum transaction, borrow 500 million in a flash loan, buy the asset on decentralized exchange A, sell it on decentralized exchange B for a small profit, pay back the 500 million, with a 3 basis point fee, and then I close my transaction. And so that's an arbitrage transaction that's very similar to traditional riskless arbitrage, except right. It quite literally is in a single Ethereum transaction that executes as a unit and confers zero credit risk on the folks who lent you that 500 million for your arbitrage plan. So pretty world changing stuff.
Yeah, let me say it another way and see if this is correct. So basically, the reason that you're able to borrow the 500 million is because you're essentially guaranteed to be able to lock in those prices, and because it's a single ecosystem. If you know that you can buy at X over here and sell at Y over there, you know that because it's part of the same ecosystem, that transaction can be secured across the way.
That's exactly right.
Yeah. I mean, these are really big ideas. This is the kind of mental shift. I mean, we were talking, I was talking actually with Jim Bianco a few days ago, who's someone who has a traditional finance background, who has gotten involved in the DeFi space. And he was talking about the mental shift that's required to jump from an order book perspective to a liquidity pool perspective, and just different views of trading, and how very often it's just difficult for people, especially investors who have spent decades in the traditional financial space, to make that kind of mental leap. And the kind of mental leap that you're talking about here, Ryan, it's a big one for people to get their heads around.
It certainly is. What we can say is that we've never met a serious person who wants to learn more about crypto, and as they've dived in, they haven't been very much rewarded with the knowledge they've gained and the change in perspective and the associated building of confidence in the Ethereum investment thesis. So for those who are thinking of taking the plunge, to putting in the time to really exploring the differences between some of the traditional financial abstractions versus the new stuff going on in Ethereum, that's going to be a very rewarding journey for you. And, to speak to the specific example you gave, Ash, in the traditional finance system, we most closely associate exchanges and trading systems with order books. I open an order, I close an order, I partially fill an order. Now, on the Ethereum blockchain, because the transaction capacity of the blockchain, the bandwidth of the blockchain is limited to maximize decentralization and maximize credible neutrality so we can all put our money on there and sleep well at night. Because there's that limitation of its bandwidth, the fees to use Ethereum have grown quite large, quite high. And it's our expectation that they'll continue to grow. And so it's necessitated new models of financial interaction where we're saying, okay, I simply can't afford the fees to open and close my orders 10 times a second, as I might in high frequency trading on Wall Street. So instead, we're gonna find ways to create effective exchanges, effective trading systems that require less active participation by the liquidity providers.
And this is precisely the point, and it's such an important one about this mental shift between order books and liquidity pools. Effectively, I mean, the short explanation for this is the transaction fees for entering and canceling orders in the case of HFT on a traditional order book are absolutely microscopic, whereas on Ethereum blockchains and other blockchains, the cost to secure the network is higher. As right now, we're in a proof of work system on Ethereum. So the idea is that you need to find a different mechanism to execute for the market microstructure in order for this to work. And I think this is such a fascinating point. Tell us a little bit more about what that means from a technological perspective and what that means from a market microstructure perspective. And then ultimately, to your point about the report and the research that you've done, what it means from an investment perspective and how this changes the economics of the ecosystem.
Because of the high fees on Ethereum and the fact that the bandwidth of the Ethereum blockchain has always been saturated for years. So it's not a question of incremental bandwidth. It's a question of, okay, there's a fixed amount of bandwidth. How do I want to purchase my allocation of bandwidth so that I can maximize my impact, my exposure, my profit from using the Ethereum system? And what's really fallen out of that rabbit hole of research and development is this idea of an automated market maker liquidity pool. And in an automated market maker liquidity pool, there's some market that could have 2 assets trading in it. It could have more, but typically it has 2. So we might say, all right, we have Ether, and then we have USDC, the US dollar stablecoin. And we're going to put them together in a liquidity pool in an automated market maker. And as a participant of an automated market maker, I'm agreeing to offer my liquidity for sale to the market at a price that's described by the mathematical equation inside that automated market maker. So that automated market maker has some kind of rule inside of it that says, today I'm willing to offer 1 Ether for $3,000. If you take me up on that offer and you're going to buy an Ether, I'm going to adjust the price up to $3,010. It's going to go up $10. And that curve that describes how the price of Ether rises as people buy it inside this liquidity pool vehicle, this automated market maker vehicle, as a liquidity provider, I'm accepting that curve. I'm saying that I can't afford to pay fees to open and close my order book, my orders on an order book all the time. Not only can I not afford it, I don't have expertise in that. I don't want to do that. I'm not ready to actively manage. Instead, I'm going to accept the curve, the mathematical curve that's inside this liquidity pool vehicle. And that's going to enable me to spend my human focus on other projects because it's not an active management strategy. And it's going to shield me from high fees because the whole system just takes care of itself instead of requiring me to continually submit new transactions to update my position on the Ethereum blockchain.
I think about this probably a little bit too simplistically, just as the difference between two different systems. Because it's very inexpensive to execute on a limit order book, you can do things in a certain way. But on Ethereum, because of the transaction costs, you have to do things in a different way. So each has its own strengths and weaknesses. And the strengths of a liquidity pool, which you don't have on a traditional order book, is the ability to have this world computer that serves as a trustless system where if you enter into a particular liquidity pool, you can basically lock that in and have it waiting, sitting there for the price that you action that you described to take effect, and know that it will programmatically be executed at precisely the parameters that you describe. And you don't have to trust anyone to do it. There doesn't have to be a trusted third party that sits in the middle. This is something that everyone who is on the chain has equal access to.
That's right. It's a level playing field that if you pay the fee, you're able to provide your liquidity. And not only is this a passive strategy that you don't have to pay fees to manage, but it also provides you with a level of certainty never before seen in the history of finance, because you know exactly at what prices you'll be selling what
Right.
amount of the underlying asset. And you also know that the liquidity pool system cannot lie, cannot break, so long as it's a secure smart contract, which involves an audit process and being battle hardened over time. But to the extent that these automated market maker systems are durable, and for example, Uniswap is extremely trusted and durable, you know that you can opt into it and it's going to follow the rules. And incredibly, it does this all without someone sitting in an office somewhere guaranteeing your position. It's just done
Right.
by the system. There's no middleman. The system, the software is the middleman.
Yeah. I think, Ryan, sometimes this is actually easier to show an example of rather than to describe, because it sounds a little bit abstract. But let's walk through a case. You used this example of Ethereum and USDC, which I think is now the most popular pair on Uniswap. Walk through what it might be like for someone who is a liquidity provider. An investor might be another way to say that, from someone from the traditional finance space who has $100 in Ethereum and has a desire to earn some yield on it.
Certainly. So if you have $100, first off, that's not nearly enough money to use the Ethereum blockchain directly because of the high fee scenario. And the good news there is that Ethereum is scaling now. Ethereum is going to be very scalable. We have an ecosystem of so-called layer 2 providers that are coming online to provide 50x to 250x reduced fees, but still the same set of financial opportunities. So to start with our $100 example, soon enough, you will be able to execute the strategies we're describing with low fees on Ethereum. So Ethereum scaling, and that's a wonderful thing. And back to the heart of the example, if we want to put some money into a liquidity provider, well, in these pools, it's a 2-asset pool. So you're not able to put just a single asset in the regular model. So if I want to put in, I want to participate in the Ethereum and USDC liquidity pool, I'm going to need, say, $100 of Ethereum and $100 of USDC. And then I take that $200 of assets and I put it in the liquidity pool. And then as users, as traders come and swap tokens back and forth, I am going to earn transaction fees. And at some point in the future, 6 months, 2 years, I go ahead and withdraw my liquidity position. What the bet that I'm making as a liquidity provider is that the fees from the trading that are paid to me will offset any potential losses that I would get from essentially being on the losing side of trades where the active traders are trading in the direction they think the market is moving.
As you make this shift from developer to investor, you mentioned earlier that you didn't see any red flags or indeed any yellow flags in the Ethereum space. What are some of those flags that you're looking for? And why would those flags, if they were to arise, show some element of risk?
Certainly. At this stage, we think there's a few main risks that are in various stages of being de-risked. The biggest risk facing the Ethereum ecosystem is that later this year, we are switching from the energy intensive, environmental unfriendly proof of work mining system, which is very similar to Bitcoin mining. And we're switching to proof of stake.
Yeah, many people have heard of this because of Elon Musk's comments talking about moving away from Bitcoin because of proof of work and the energy consumption component.
That's right. And Elon Musk's comments come at an interesting time because the Ethereum community is 5.5 years towards into a 6-year process of a planned upgrade to make Ethereum environmentally friendly, as well as more secure and much more profitable for holders of the Ethereum token. And later this year, we're going to take the airplane that is Ethereum that's flying through the air that did 1.6 trillion in settlements in Q1 of this year. And we're going to switch its engine from the proof of work energy consuming engine to the proof of stake engine. And all evidence suggests that proof of stake works and that it's a transformative technology that is going to dramatically set Ethereum up for the next, the coming decades as it grows to global ubiquity. However, there's a risk that a researcher that nobody's ever heard of comes out of left field and they find that there's some kind of problem with the proof of stake system that can't be fixed. Nobody thinks that's going to happen, but because proof of stake is not yet live today, because it hasn't yet been securing trillions of dollars for years, we don't yet have the accumulated confidence. And so the success of proof of stake is the number one thing that insiders are looking for to continue to build confidence in Ethereum's growth.
Yeah. And where are we on that? This is a complex process for people who aren't in the space. Understanding this transition from where we are today with Ethereum to Ethereum 2.0, it's not just a simple switch over. You basically have two systems running in parallel right now. Tell us a little bit about that for people from a non-technical perspective who are trying to get their heads around this big idea.
The new proof of stake system is actually a brand new blockchain in a physical sense. It's not a new community, it's not a new app platform, but it's a new blockchain in a physical sense. So if we think of the Ethereum blockchain as been in production now, serving live transactions for coming up on 6 years, it's running over here. And last December, 6 months ago, the community started the new Ethereum 2.0 blockchain, the so-called beacon chain. It's over here. It's been humming along for 6 months. Practically without issue. In fact, there was only one issue and everyone agreed that the system performed admirably and we learned a lot and it wasn't a big deal. So there's this new blockchain that's been running alongside for 6 months, building confidence, building operational expertise, accumulating history. And when that blockchain is about a year old, it will become the new heart of the Ethereum production system. And that's the two chains in parallel today that will merge and become a single chain that is the future of Ethereum later this year.
So we've been talking about your report tangentially. Tell us specifically the new report that you've just put out that is relevant to understanding some of these financial economics. What were your findings? Why did you start looking in this direction? And why is it so important?
Our report, which is publicly available at ethereumcashflow.com, articulates our belief that for all of crypto's history, almost all of the prices are fully confidence-based and not backed by cash flow. This is the so-called lack of intrinsic value that has been one of the main line items for the critics of crypto. And the truth is, they're not necessarily wrong. When Warren Buffett buys a stock, he buys it for the dividend. Yet, when we look at the US dollar as a fiat instrument, that's a confidence-based instrument that's backed by the American economy, the American government, American military. Ethereum and Bitcoin to date have been more like fiat and less like a Warren Buffett stock. Their prices are driven entirely by confidence and the expectation that more and more folks will get involved in the space and building the confidence and building the common knowledge that these assets are legitimate. Where Ethereum is reaching a catalyst and really excites us, and we believe drives the investment thesis, is that because Ethereum has many more uses than Bitcoin, if you own Bitcoin, you can only do two things with it. You can hold it or you can sell it. And that's just a fact of life. Bitcoin is not and will never be an app platform. And those who claim to be building DeFi on Bitcoin are actually building systems that are adjacent to Bitcoin and not secured by Bitcoin.
Yeah, this is a very important and in some ways contentious point. The question about whether Bitcoin can serve as a base layer for DeFi with L2 or layer 2 solutions built on top of it. And to your point, the idea that Bitcoin is not able to actually secure the layer 2 solutions, but it has to be built upon with another layer that does so is a really important point and a distinction between Bitcoin and Ethereum.
Certainly. And Bitcoin was not designed to be an app platform. Ethereum was invented as an app platform specifically because Bitcoin was not designed to be one. Bitcoin can never be as effective an app platform as Ethereum. And the truth is even worse. The truth is that proof of work as an energy consumption-based security model is not able to provide security for a larger set of assets than the market cap of the native token itself. So let me unpack that a bit. If the market cap of Bitcoin is $1 trillion or $10 trillion, whatever we may kind of hope or wish it may become, let's say that someone would say, all right, great. Well, we're going to build a DeFi platform on Bitcoin. And as a result, we're going to take $100 trillion of assets, real estate deeds, sovereign bonds, corporate treasury. We're going to put them all on Bitcoin DeFi. Well, that is literally impossible because the proof of work security is not physically, economically able to secure more value than the market cap of Bitcoin itself. And the switch to proof of stake for Ethereum is so exciting because proof of stake has the characteristic that if the market cap of the Ethereum token was $10 trillion, that's $10 trillion of proof of stake security. We're actually able to secure $200 trillion of global assets on that $10 trillion Ethereum token market cap. It's because proof of stake has the fundamental characteristic that it can secure more value than the total value of the proof of stake token. Proof of work cannot and will never be able to. And this
Ryan,
means
can you
that,
explain a little bit about how that's possible?
Absolutely. The intuition behind it is that in a proof of work system, you compete to control the outcome of that system by spending more energy, by inventing faster hardware that does the mining process faster. And anyone can do that in a way without asking anyone else. So that if there was folks who were able to come up with Bitcoin mining hardware that was 100 times faster and they had cheap electricity and they were able to do this from a small island nation somehow, they would control the fate of the Bitcoin blockchain because it's an open access model based on energy consumption and solving the cryptographic mining puzzles. With proof of stake, you control the outcome of the system based upon your ownership of the token, your ownership of the Ether token. So if I have 1% of the Ether tokens that are participating in the proof of stake validating system, I get 1% of the votes. And so if someone wants to try and control the outcome of the system to steal some money, the first thing they have to do is they have to go and purchase on the open market extremely large quantities of the Ethereum token supply so that they're able to get enough votes to change the outcome of that system through their voting power in the proof of stake validating system. And so that's kind of only part one. Part two is that if someone is successfully able to execute this attack, and in the Bitcoin world, in the mining world, they're able to get 51% of hash power and they control the fate of the system. Or in Ethereum, if they buy so much of the Ethereum token that they get so many votes that they can change the outcome of the system. Well, the defense mechanism, the immune system built into the network is totally different between the proof of work and the proof of stake. The proof of work immune system is a limited response. You're able to continually deploy your capital to attack the system day over day, whether you're renting graphics cards from Google to do it, or you've bought your own computers that are your property that you can continue to run them day over day to attack the network successively. You can continue attacking the Bitcoin proof of work network in a capital efficient manner. In proof of stake, what will happen is the community will rally together on a global basis, on a political basis, and we'll say, boy, that entity just bought so much of the token supply, and they're trying to attack the system. They're trying to violate our property rights. They're destroying credible neutrality. Do we all agree that we should fork the system and destroy their capital? We'll take their token balance and we'll make it a zero. And that is a very credible threat as an immune system response to respond to an attacker to a proof of stake system. As a result, it's just simply not practical to attack proof of stake systems on an economic basis.
Yeah, that's very well described. And that's a very complicated concept, I think, broken down in a way that people can understand it from a series of economic incentives rather than technical implementation. I have to ask, in terms of threats, in terms of risks, one threat or risk that we haven't talked about yet is what I guess I could call it the infinite regress threat. The idea that you have a 90% concentration in Ethereum and the risk that there will be just a series of other tokens that come up that can potentially serve the Ethereum function, the smart contract function, more efficiently, more cheaply, more elegantly, and therefore potentially displacing Ethereum. This is an argument that we hear very often from people who are skeptical of the crypto community, and it's in its sort of coarsest form. It takes the form of, well, why would I invest in Bitcoin? Why would I invest in Ethereum when I don't know if 3 months from now, 6 months from now, 2 years from now, there may be systems that surpass them. Give us a thumbnail sketch of why you're so confident in the Ethereum ecosystem that you have a 90% concentration of risk there.
That's right. I have a 95% concentration of risk in the Ethereum asset because there are
95%. I actually understated it.
That's right. It's a lot. I think it is 95% and maybe even a little higher. I just have slivers of other tokens that may someday do well. And the reason is that, first, Ethereum is scaling. So today, Ethereum does something like 12 or 15 transactions per second. That's not the future of Ethereum. And that's really important because as Ethereum scales to global ubiquity, if it literally was not able to satisfy the growing demand, then we wouldn't be able to argue that it would capture that growing demand. But reality is the opposite. Ethereum's scaling solutions are online now, maturing now, and they will enable Ethereum to capture the demand as it grows to global ubiquity. And now that's the first thing. The other two are, why will the demand prefer Ethereum? Well, there's very strong reasons to prefer Ethereum. The first is that Ethereum has a virtuous cycle where we have an existing body, an existing app community of applications, including financial services, exchanges, trading systems, lending systems, options. All of these are live on Ethereum today and much more. We have an existing body of those. We have our tokens. We have our liquidity. And then those things drive the user experience, the open access user experience of those who want to get involved. And then the user experience drives increased transaction fees, which drives increased revenue to Ether holders, increased profit. And then that drives an attraction of new developers who want to be where the action is at. They want to capture application level fees, which are a different set of fees because there's the fee to use Ethereum directly, but then there's also the fees that are paid to, for example, Uniswap liquidity providers. So as the stream of cash going to Ethereum grows, it attracts more developers, more builders, more investment, which builds the customer experience, completing Ethereum's virtuous cycle. So the virtuous cycle is that great applications drive great user experience, drives increased cash flow and revenue from greater traffic, which drives further investment in the building side, which drives even greater applications. And we've just been seeing that virtuous cycle spin round and round at a mile a minute.
Yeah.
And what really drives that virtuous cycle brings us to the second thing, the second reason that Ethereum has such a strong moat, a strong defensibility. It's because that whole cycle can only spin as fast as the Ethereum blockchain is trusted. If there was a trust issue, it's going to undermine the ability for new users and new developers and new capital to find its home on the Ethereum blockchain. But because the Ethereum community and software has such a strong accumulated history of being immutable, no history changes, as well as credible neutrality, which is that all important idea that if you're a government, put your sovereign bonds on Ethereum. You can trust Ethereum. No one government controls Ethereum. And those two ideas of no changing the rules and credible neutrality, which is sort of like the same thing, but at a political level, those have driven a confidence in Ethereum that has just caused the level of adoption to explode. So if Ethereum's network effects are strong and growing, and it's just simply not possible for a new blockchain to swoop in and take Ethereum's apps, tokens, liquidity, trust, credible neutrality, developer community, global recognition. And as an example, in the recent weeks, the European Investment Bank, which is the investment arm of the European Central Bank, issued 100 million euros of bonds on the Ethereum public blockchain with their partner Goldman. That's credible neutrality in action.
Yeah. Economies of scale, network effects, things that we've been talking about here on Real Vision for some time. Such an interesting conversation. I'm curious, we've touched on a lot of different areas. What are some of the final thoughts, final takeaways you'd like to leave our viewers with?
Well, in our April report from mid-April at ethereumcashflow.com, we had projected Ethereum's revenue at 8 billion for this year. And from May 1st to May 24, for that 3.5 week period, and we go ahead and annualize that, Ethereum did 14.6 billion in revenue, exceeding our forecast for the year by over 80%. So we're just so excited at the growth we're seeing. We're excited at the continued and escalating involvement of capital allocators, governments, institutions. We're excited that Goldman wrote a report on Ethereum last week. We're excited that more and more branches of the US government have had kind things to say about Ethereum, supportive things. So the future's bright, and it's going to be a tremendous several years of growth.
Yeah. The market cap right now, as we record this for Ethereum, is about $330 billion, just under. Obviously, this is still relatively new here, coming 2015, the initial release date of Ethereum. So it's still very early, but such a fascinating story, such a fascinating case that you've made here today. And it's especially interesting to hear someone talk about this who has the background of a developer, who's a participant in the Ethereum community, and who also serves as an investor.
Ash, thanks for having me today.
Ryan, thanks so much for joining us. Thanks for watching, everyone.
I hope you enjoyed this special episode of The Interview, the premier business and finance series in the world. However, this is just the tip of the iceberg. For more in-depth content and expert analysis, visit the membership link in the description to unlock a week's access for only $1. This dollar can change your life.